Right, so we should see that coming through. We have just started the recording. Once again, this is Brian Wilson, market strategist here at Market Structure Edge. Thrilled that you can be with me here today on December 11th. Just a couple of rules as we walk through the presentation and the demo today. All questions are welcome. You can just write your questions in the chat discussion line, and I'll get to those as we proceed through the meeting. I do have 5 or 6 topics, but if it's anything like last week, I'm sure we'll kind of delve into other topics that are of interest to you. Let me see if there's anyone else here in the meeting to let in. Looks like there's a couple of people here. All right. We'll go ahead and get started. I'll share my screen. And once again, feel free to write any questions that you have in the chat room, and I'll check that on a regular basis during the course of the demo. So we'll go ahead and get started with today's talking points. I wanted to start the discussion by actually talking about yesterday's trading. Obviously, yesterday was the FOMC meeting. I wanted to share with you what was happening in the background, and I believe I mentioned this in today's market desk note. This is just an example of one of the reports that we send to our IR clients, investor relations clients. What I wanted to share with you is what was happening to the S&P 500 yesterday. So on a day when we had the FOMC decision, broad-based rally across the market, which behavior was leading the way? That was fast traders. Fast trading levels up by 3%. That's on a day-over-day basis. You can see actually the same exact thing happened for Ameriprise. They happened to be higher by 4% yesterday. But as a good example, if they were to talk to their management team and say, hey, our active investors were just gung-ho about trading yesterday, that was really not the case. Their active investor levels were actually down on a day-over-day basis. So the takeaway here is that the machines tend to be very active on news days, whether that's FOMC, whether that's earnings, whether that's broker upgrades, whatever it might be, that tends to be machine driven activity. And for those that are new to our discussion points here, I'll circle back briefly to a topic that we discussed last week. 4 behaviors in the marketplace. This is what the world looked like roughly 1995. As you can see now, it's basically like waking up on a different planet. Instead of active investment being 80% of order flow, active investment is currently about 10% of order flow. We have fast trading activity. Let me admit a couple of people here. We have fast trading activity that's about 46% of activity. And as an example, and I know this question was asked last week, here's a couple more examples of fast trading firms. Quant Lab, Hudson River, Virtu, Citadel. Those are some of the examples of what we're talking about with participants in the fast trading bucket. And then passive money, about 25% of trading. We're going to circle back to passive investment activity here in just a couple of minutes. I have a couple of slides that I want to share with you. And lastly, the risk management component. But, once again, this 2024, 2025, very, very different than 1995. And it is interesting, though, when I talk to executives, whether they be CFOs, CEOs, board members, it's still a very common belief that this is the world that exists out there. So the point here is that many of you are taking on knowledge here that is just not commonly known, even with some of the C-suite executives in the market itself. So fast trading activity yesterday. Let's talk briefly about. I mentioned this in today's note. I mentioned that sentiment is currently above 6 right now, and let me show you what that looks like. And I'll review this concept from time to time. My system's being just a tad slow. There we go. So the concept is red line trading, and you'll hear us talk about the red line from time to time. You'll hear us talk about the green line from time to time. The red line is market structure sentiment that is 6 or greater. Sentiment itself is here in the green indicator. And over time, let me give you an example of the ebb and flow of sentiment over time. This is what sentiment, once again, here in green looks like. We have a natural just progression. It ebbs and flows. We move above the red line, we move below it, we move above it, we move below it. These are regular demand cycles, and these were demand cycles back in 24 and back in 23 as well. And you can see where we're at right now. Once again, we've moved above that red line. Let me share with you what normally happens in that environment, and I'll switch over to a spreadsheet to give you an idea what we're talking about here. I'm not going to go through all the details on this spreadsheet. I just want to hit the highlights. But what we're looking at is trading from 2020 all the way through July of this year. And what this is measuring is when we move above the red line and when we move back below it. So for instance, back here in July, early part of July, moving above it. We fast forward in that case about 2 weeks, moving back below it again. What's the market performance during that time period? And what's the market performance afterwards? And that's what this spreadsheet is measuring. So once again, 2020 all the way here through 2025, that period above the red line, we average about 60 basis points. Now, if we look 2 weeks afterwards, where are we at that particular time? Once again, our performance is about 60 basis points. So the point here is that market gains tend to slow down, but the market still posts gains. It doesn't tend to implode. And then afterwards, the market still tends to post gains afterwards as well. Now, there are outliers, of course. We had really one of the most significant outliers, and let me back this up a little bit farther to show you. We had one of the most significant ones in our data set going back to April and May of this year. And my system will catch up here in just a second, I think. If not, I'll just talk through it. It's being really slow for some reason. Let me show you what it looked like. So our outlier in April and May, you can see that once again, we were coming off of the tariff drama, and we had appreciation during that period of over 12%. So really just an extreme outlier. But if you look at the data set, there's really not that many outliers. Maybe 10 total in the course of about 6 years. So once again, the point here is that we are a little bit stretched right now. We're stretched from a sentiment perspective because we have moved above that red line indicator. One item of consideration here, where we're at right now in this particular cycle, and let me see if this will circle back. Okay. So once again, we're above red line trading. A great example of what we saw coming through options expirations last cycle. And as a reminder here on our broad sentiment page, when you see the little green squares, that will indicate either expirations activity. In this case, last period, it was VIX expirations followed by regular expirations, those next two dots. The last one is the end of the month. But great example, downside into expirations. We had mentioned that one possibility coming out the other side is that markets that tend to be down into expirations, well, they often have a central tendency of moving higher afterwards. It's exactly what happened with this particular cycle. We are coming up on expirations again next week, and so far we've had gains into this expiration cycle. We'll talk more about this when we talk about the road ahead, but I kind of think in the short term, this body that's in motion to the upside probably stays in motion until expirations next week. We'll have to see how that plays out. Just as a reminder, and let me show you what this looks like as well. This is, and let me show you how to get here for those that are not familiar. So just go to Market Structure Edge. You'll see us most mornings talk about context in the marketplace. A lot of times we're talking about the expirations calendar, and this is what we're referencing. We're coming up on a very busy week next week. You can see we just came through the FOMC decision yesterday. Next week, VIX expirations, regular expirations activity, 18th and 19th. And then the 19th has that green circle. That's S&P quarterly rebalances. We're rapidly approaching year end after that. So what I would expect is that trading that needs to get done, if something really needs to get done, some of that activity probably gets pulled up into here. In other words, expect heavy trading volumes as we move through next week itself. Let me stop then for a second, see if any questions have come in. Hopefully I haven't confused you too much. Let's see, looks like Brad has a question. Let me see if anyone else has. Joe had a question whether the fast trading trend continued through today or did passive step back in. Joe, let me go ahead. I'll share with you what's been happening in the background. I don't know for sure which behavior it is, but we usually have a good idea based on the patterns in the market. And let me show you what's happening here. So S&P 500 coming into yesterday, this is a big picture perspective. What was moving in the market? Well, on a week over week basis, active money was moving in the market. What was the performance? Basically flat, up by 20 basis points. This is how the market had been closing recently. 3 days out of 5, it had closed below midpoint pricing. So it wasn't extremely strong coming into yesterday's trading, but active money was leading the way. If we look at the SPY, kind of the ETF side of the equation, and what I'm showing you here is what's happening from a trend perspective. That's what behaviors are having the greatest impact. Once again, 3 days below midpoint pricing, 2 days above, flattish trading. Let's call it passive investment rotation with active money in the background. What does that mean today? Who's circling back into play? Probably these same behaviors, probably a combination of active and passive money. Let me circle back to the questions. And Joe, we'll know that for sure on an overnight basis, once we get the trading details. Question from Brad. He said, last week I asked about which bucket retail traders fall into, and I had answered that was fast trading. And Brad's just asking for a further explanation on that. So essentially, when we look at those 4 behaviors that we just talked about in that previous slide deck, so when you think about the behaviors in the marketplace, those fast trading firms have bought up the retail order flow. It's part of the reason that I can trade for free on Schwab. No one wants to give me something for nothing, but that has come through because these fast trading firms have done so. So they buy up the retail order flow. They essentially know everything that's going on in terms of those limits. So not only are they the fastest to market in terms of being proximity to the order routers, but they also have bought up this order flow itself. So Brad, that's why fast trading order flow why retail order flow will show up under fast trading itself. It's because those firms have bought up that order flow. So when I place an order on Schwab that I did a couple of orders this morning, I'm going to come through as a retail trader. Hopefully that makes sense. Um, I covered the sentiment above 6. Let me circle to a topic that we haven't explored here in a little while. That topic is that of short volume. And I know short volume can sometimes be a little bit confusing. Minimize a couple of these windows that we've been talking about. Um, So this is a slide deck that we will sometimes share with our IR clients to help them get a little bit of understanding in terms of short volume versus short interest. Short interest is what basically everyone on Wall Street is familiar with. That's what you hear all the time. Short interest itself averages about 3% for the S&P 500. It's looking at the percentage of shares borrowed, sold, not yet covered as a percentage of the float. So that's, a real big difference here. Percentage of the float, a lot of times, significant portions of a float will not actually trade. You can see what it looks like here. So this is average S&P 500 shares outstanding, short interest itself. Average shares outstanding about 300 million. Average short interest, this is 2023 data, about 2.4%. So when you think about that, short interest itself is not setting price that often. It does occasionally, but as a general principle, these shares are not, for the most part, trading that often. You think about shares that are in lockup, or you think about shares that are owned by certain portions of management that are just, really not accessible to the market itself. If we look at daily volume for the S&P 500 from a short volume perspective, though, that is very different. Short volume covers 51% of daily trading. And let me give an explanation here, which maybe will shine a little bit of light on it. So when we think about short volume, think about the percentage of trading from borrowed shares. So when I think of short volume, I think of borrowed shares. Now it can be the traditional shorting that I just shared with you, market participants who believe that share price might decline. It can be market makers, think of fast trading activity. Sometimes it can be ETF brokers, but it's shares that are being borrowed in the marketplace for that particular reason. And most of the time it's for market making. Sometimes it's part of the ETF process. But there's a big difference. S&P 500 short volume averages about 50%. Once again, short interest itself averages about 3%. And when we look at our clients on the investor relations side of the business, well, 50%, that's about the market average. When things get up to about 60%, well, you're starting to get a drag on stock performance, and then you get outliers either way, 70%, 80%. Shares might be under a short attack. 30%, could be aggressive short covering. Maybe there's deal arbitrage or activism going on. But, basic definition of short volume, think of it as borrowed shares once again in the marketplace itself. Let me give you an example. And I was talking to one of our participants ahead of this meeting about this stock, and I think it paints a pretty good picture. So if we look at Corning, and if we look at recent trading here, it's a good example of what can sometimes happen in the marketplace. And I'll kind of talk through this with you because sometimes it perhaps doesn't make a lot of sense. But look at what's happened to Corning recently. Short volume was down at 37%. Share price was at about 84. share price up at 94 now. So a rally of about $10 with short volume moving from 37% all the way up to 59%. So what happened here? Well, obviously there was tremendous demand for Corning shares. So there was demand for Corning shares. And once again, think about who is then doing the shorting. In this case, it was likely market makers. There was demand for Corning. Fast traders created some of these shares in the marketplace because of that demand. So short volume rises to fill that demand. That's why you see short volume rising, in this case, at the same time as share price. Now, those that have shorted these shares, they have about 35 days, over 30 days to cover those short positions. So it doesn't have to happen immediately. But if we look at what, and this is a central tendency, but if you look at this last month or so, this gives you a good flavor for sometimes what we'll see in trading. So in this case, when we saw, share price moving higher for Corning, well, short volume moved higher at the same time to accommodate some of that demand. When we saw share price moving a little bit lower for a period of time, well, shorts got covered at lower prices. But notice what happened when shorts did get covered. That set Corning up for another period of gains. And you see how that played out in the marketplace. You see a little bit of short covering, share price stalls for a period of time, and then it's ready for additional gains. Now, of course, you can have low short volume in the marketplace. That happens all the time. What does it require though for gains? Well, it requires demand. It requires sentiment moving higher. So we see in this case sentiment moving higher at the same time that short volume was low, and we see that share price then moving higher as well. Let's go and take a look at one of the current names in our daily trading ideas. And usually I'll sort these by probability. And I think I was looking at coherent earlier. So let's go take a look at that one. Once again, the topic is short volume. And sometimes that will, what will that communicate in the marketplace? And remember that we're talking about borrowed shares. So if we look at coherent, actually very similar, right? We see sentiment really starting to take off. We see shorts getting covered at the same time. Really a classic definition of a momentum stock. We're getting short covering at the same time that we're getting strong demand. That's part of the reason why it hits that momentum portfolio. And it's part of the reason why we can have this tremendous upside then in terms of that appreciation. But once again, look at the short covering, and accompanying the short covering is that increase in demand at the same time. And that's part of the reason why that becomes or is a momentum stock. Hopefully I didn't muddy up the waters too much there. I just wanted to give an example of what happens there with short volume. Circling back to a couple of questions. Great question from Candace. Her question is whether passive investment is more ETFs rather than retail traders. And that's exactly right, Candace. When we think of passive money, we think of index funds, ETFs, quant fund activity. That's the three behaviors that we typically lump into passive investment. Brad has a question here. It might take me just a moment to read it. I have a question about trading ideas. For example, yesterday would have been a good time to take profits near the end of the session versus waiting overnight. He traded Apple from the Edge Momentum portfolio. And then a question is, how can I find on Edge what the volatility of Apple is? Then he could set a good good till canceled exit order at the entry plus the daily volatility. You can find that under, and let me share my screen again. I'll show you. You can find that under any of the portfolios itself, or you can find it under the sector activity. If you're looking for something like Apple, I would just start with big tech. You'll find it in there. Show you what that looks like. So here's the daily volatility, and if you were looking for Apple right now, it's really low, but 1.4%. And if you're looking for any particular name for that daily volatility, if you're trading from the daily trading ideas, you'll find that right here, that fourth column over. And actually, that is sorted right now from most volatile going down to least volatile. Keep in mind, that volatility equation. If you are trading from these portfolios, what this means is that that's the potential where ASTS can move in a given trading day. Personally, I tend to opt for ones that are a little bit less volatile. Um, it can be a lights out day and you can make 10 or 11%, but you can also be down 10 or 11%. So just keep in mind that volatility measure in the momentum portfolio, especially low volatility, of course, is not the same issue. The greatest one that we see there right now is only 2.1%. One other way that you can search for volatility, uh, just go to one of the sector portfolios and you can look for it that way as well. So if you're looking at communication services as an example, and I'm not even sure what that stock is, but if you're looking at Tune, that would be its volatility right there, 3.7%. And for any of these, you can export portfolios to Excel. And if you wanted to see what that volatility was for that entire portfolio, let's get my screen out of the way here. And you can look at those volatility metrics. You could capture it for the entire portfolio if you want to. So just as a reminder, where you can go for that information. Let me circle back and see if there's any other questions here. Minimize a couple of my screens. Question regarding short volume. Does it have to be below 50% to make the momentum portfolio screen? AJ, I don't remember right off the top of my head. I believe that is the case, but I don't remember, right off the top of my head. But I do think that is the case. It does have to be moving lower, though. Be cognizant of the time here. I do want to introduce one other concept. You've heard Tim and I talk about it over time. It's the overall passive investment trend in the marketplace. This is part of a presentation that Tim did recently. He's actually doing this same presentation this afternoon. That's part of the reason that he's not on today's call. Passive money is basically like the elephant in the room. And this is geared towards IR teams, but it has implications for us as well because it tends to move the market. If we look at what is happening in the equity market, top 25 holders of US equities dominated by passive investors. Almost every name on this list is some type of passive investment vehicle. There was only one active fund, that was Capital International Investors. So the rest have moved towards asset allocation, strategies, models, ETFs, etc. Couple of hedge funds that were in that category. Look at the growth that's occurring in ETFs that just continues really to proliferate. If you look back in 2017, this is in trillions of dollars. ETF assets, about 3 trillion. You fast forward to now, that number is about 12 trillion. If we look at the what we call the creates and redeems, this is on a monthly basis, about 2.9 trillion there, about 10 trillion now. And this is what it looks like on a monthly basis for the create and redeem, and that just continues to grow over time. Even moving from 2024 up to 1 year later, we had about an increase of about $2 trillion just on a year-over-year basis. So ETFs continue to grow. Where does that money, in general terms, tend to go to? It tends to go to the mega caps. They're about 75, 76% of market cap, over $50 trillion. That's where the money is going to tend to go over time. And what are we going to see over time? We're going to see those cycles in the marketplace. I showed you what this looks like, and a lot of this is ETF activity. It's ETFs moving in and out of the market, create and redeems, and you see that ebb and flow over time that kind of plays out in the marketplace. Let me see if there's any other items I wanted to share from that slide deck. This is a good one. This shows the general trend for active investors over time. This is from 2015. You can see that active investors just continue to lose money. Who are they losing it to? They're losing it to passive investors. And one last example, if we look at Capital Group, the top active performers, they have endured 5 straight years of net outflows from U.S. equity funds. So active money continues to suffer, and active money continues to suffer at the expense of passive investment. So those trends just continue to proliferate. Anesh had a question, any way to watch Tim's presentation? There might be a recording, Anesh. Let me ask Tim from what he presented last week. Today he's talking to a specific company, so that one won't be recorded. But I'll ask the question to see if last week's presentation was recorded or not. Let's move over for a second to the model portfolios. And for those who are not familiar with them, let me show you what it looks like. We have 2 model portfolios. One is what we call the Edge Focus Momentum. And I'll share the criteria here with you. These are companies where demand is greater or equal to 8, trend is up, it has a dollars per day criteria, has a short volume criteria or as well, and then it has an exit criteria that comes into play. Once again, this is the Edge Focus Momentum. What has happened over time is the portfolio was doing exceptionally well up until the end of September, where we were up at about 50%. You can see that it's tailed off since then. We're still doing much, much better than the broad market. Let me show you the performance numbers through yesterday, up about 41% compared to 17.6% for the broad market. But once again, it's been a little bit more of a challenging momentum market here for the last couple of months. The other portfolio that we have access to, and by the way, this is in access on a daily basis. We send out these portfolios, any updates to them every morning. It's usually about 5 o'clock Mountain Time. So what you're looking at here is our low volatility portfolio. At one stretch coming out of November expirations, we got all the way up to 70%, has tailed off just a little bit. That was an exceptional run. But 70%, and as of yesterday, that portfolio is at about 66%. Different criteria. The criteria for this portfolio, looking at sentiment equal to neutral, intraday volatility is a little bit lower, Market cap range is one of the criteria as well, and it has a supply demand divergence. And then the exit criteria is down here. If you are a subscribed user, not just a trial user, and you want to get access to these portfolios, just send an email to myself or Tim, and we're happy to get you signed up. And if you want to just get signed up and track along with it for a period of time, what it will show you, and I'll give you an example this morning. This morning, when we sent out the email, this is the low volatility. It recommended getting out of AVGO and BRK and then getting into NVIDIA and Apple. And you can follow all the advice or some of the advice. It's totally up to you, but you can see what that performance is over time, and you can go back over time and take a peek at what the portfolio was. What was it doing back during certain cycles of the year. Last topic for me, unless there's other questions, let's discuss the path ahead for a moment. We've talked about part of this already. Right now, we're in the middle of a stretched market. So once again, stretched market above the red line for sentiment. What that means is that gains tend to level off a little bit. The market doesn't tend to implode, but historically, over the last 5 or 6 years, we've seen gains of about 60 basis points when we're above that red line. We are coming up on expirations next week, the last expiration cycle of this calendar year. We've had gains so far coming into expirations. Will that continue into next week? I would say there's a pretty strong likelihood that that's the case. But once again, remember, we are stretched right now. So it would be an outlier for the market to post 5% gains in the next week. Could it happen? Of course. There's always outliers, but central tendency tells us it's probably about 60 basis points in this market environment. As we get into one thing to consider, I'm mentioning that there's a decent possibility of upside into next week. What could potentially happen after that? Well, look at what happened coming into November expirations. We were lower into expirations. We were higher afterwards. If we're higher into this expiration cycle, what's the likelihood afterwards? Maybe lower. So just kind of tuck that away in the back of your head. We could change direction after expirations next week. The last consideration is a big picture consideration. I have no idea if this will occur or not, but it's just something I've been tracking here recently. What we're looking at here is we backed up this look. This is a 5-year look. Once again, the normal rhythm of the market where we see the ebb and flows for demand cycles over time, especially in 23, especially in 24, you can see those regular cycles that were occurring. What have we tracked recently? Well, the demand cycles up until this last one have weakened. You can see that weakening over time, just not as great of demand in the marketplace. And if we look back at other occurrences, we can see short-term occurrences. You can see back in 23, what happened. And the one that this most closely resembles to me goes back to 21. So you can see demand cycles that really fell off in 21. What was the implication of that? We really didn't see it until the next logical inflection point, which was then at the beginning of 2022. So I have no idea if this will manifest this way or not, but it's just something to tuck away and say, hey, we've had weak demand in the background here for a while, for the last few months. Could that potentially manifest at the beginning of a new year? It's certainly a possibility. It's something that I just want to be aware of. A couple of other questions coming in, and thank you very much for all your questions, guys. I appreciate it. Question from Brad. Do you know what the look back is for daily volatility? In general terms, Brad, SPY is generally 1%. Underlying stocks for the S&P 500 are generally 2%. That's probably the best that I can give you there. So let me show you what it currently looks like. So S&P 500, if we look at this is what our investor relations report. But if we look at S&P 500, and I give you guys this data when I do my daily notes, but here's our 5-day number. There's the 200-day number. We've had a little bit more volatility this year than we typically do, but that number on a 200-day basis is usually about 2%. For the SPY, and that's the report you're looking at right now, on a 5-day basis, that's 70 basis points. This one is actually a little bit closer, but that 200-day number, 1.2. So in general terms, SPY is usually about 1%. Underlying components of the S&P 500 are usually about 2%. See if there's any other questions. Okay, Joe was just going through a question in terms of looking for volatility. Felicia had a question. Could you share your email? Sure. It's bw@marketstructureedge.com, and you can also see that in the daily notes. And you can send an email to either myself or Tim. With the focus momentum portfolio unstable for the last couple of months, is the standard momentum portfolio in the dashboard performing similarly, or is it more stable? That's a question from Candace. Candace, in regards to that, I would look for those individual stocks. So if you look at, what is in that portfolio at any given time, and you can see the criteria. So you look at the daily trading ideas, and you can see, what are we looking at here? And it gives you the criteria for that, and it's going, once I click off it, you can't see it, but about halfway down, it's looking at trailing 90-day data. So in other words, if you're looking at a name here, ASTS, every time it's had the same setup in the last 90 days, it's made that percentage gain 100% of the time. So these ideas that pop up here, even though the momentum portfolio, the email version that we send out, it's been a little bit choppy. On a daily basis, on a name by name basis, this applies for the last 90 days. Well, guys, I have covered a ton of material. Can I cover anything else for you guys today? Thank you for the wonderful questions. I really appreciate it. If not, I will go ahead and end the recording for today. Just as a reminder, Tim will be back